the 4-year cycle is effectively broken with the maturation of Bitcoin as a strategic asset with the ETFs and now the strategic treasury and whatnot. I think the adoption is driving demand. I mean, if you read anything about their most recent ETFs, they've consumed infinitely more Bitcoin than have been generated so far this year. So I think effectively that halving cycle is broken.
Welcome to the Bitcoin mining panel sponsored by Aquapana Water. Everybody should have their Aquapana. Just want to thank Salt, want to thank John, want to thank Anthony for having the Bitcoin miners up here. As many of you know, a lot of the industry had given up on Bitcoin miners, but unlike Bitcoin treasury companies, Bitcoin miners can actually create new Bitcoin at a price below the current market price, and actually the network can't run without Bitcoin miners. So in my opinion, we have 4 of the very best companies, public companies here in the space globally, 4 of the largest companies, and we have in particular 4 of the best executives, strategic thinkers in this sector. So let's start right here next to me with Matt Schultz, the CEO of CleanSpark, and we'll go down the line.
Thank you, Mike. Thanks for having me. My name is Matt Schultz. I'm the co-founder, executive chairman, and as of a week ago, returning CEO of the company. We started as an energy company 15 years ago with a portfolio of technologies on energy generation and distributed energy resource management systems, and we've evolved to become, I would say, one of the largest Bitcoin miners on US soil. We have 50 exahash of processing capacity. We have just over a gigawatt of electricity in our contracted pipeline with about 1.2 gigawatts behind that. And as Mike mentioned, similar to a treasury company, we sit on 12,500 Bitcoin that we mined all of those. So we've also grown to take opportunities to monetize our Bitcoin through different, we have a digital asset management trading desk. So I'm excited to be here, excited for the conversation.
Patrick.
Hi, Patrick Fleury, Chief Financial Officer of TeraWulf. We are a power and infrastructure company. We do both Bitcoin mining and develop high-power compute co-location hosting facilities. We have about 250 megawatts of Bitcoin mining today at our Lake Mariner site. We did develop the first and I think only Bitcoin mine behind the meter at one of the nation's largest nukes a few years ago with Talon Energy. And we recently, last week, signed a deal with FluidStack and Google to develop 450 megawatts of high-power compute at our upstate New York site. We have 1,150 megawatts total in the company. And yeah, I think unlike some of the other folks up here, our philosophy from day one has been we love Bitcoin, but we mine it. And we make a profit on mining it, and then we sell it. So we do not hodl. I know that'll probably be an unpopular commentary up here, but that's been our fundamental financial strategy from day one, which, like I said, a bit different, but big believers in Bitcoin and love this ecosystem. So thank you for having us.
Ken?
Ken Draper, Chief Commercial Officer at IREN. We're a next-generation data center company powered by renewable energy. We have been focused from day one on multiple different use cases for our infrastructure. We've got over 3 gigawatts of secured power in the portfolio, currently operating across 3 different verticals: Bitcoin mining, AI cloud services where we own GPUs and provide GPU as a service style compute, as well as AI co-location at our data centers.
Salman.
Hi, good morning, everybody. Salman Khan, I'm the Chief Financial Officer for Mara Holdings. Mara, from an exahash and market cap perspective, is the largest, one of the largest, and we have global operations here in the US and partnerships with sovereigns in Abu Dhabi and elsewhere. Our story has evolved over a period of time. Until beginning of last year, we were asset-light company, which meant that we rented rack space and deployed miners and hash, and as a result of that, we grew very quickly to be one of the largest. We pivoted towards asset heavy last year, and we exited the year with 70% of our capacity as owned and operated. That resulted in our electricity cost per coin to be one of the lowest in the sector. Our goal and objective is to mine Bitcoin irrespective of halving, and as a result of that, another strategy, amongst many strategies that we've deployed, is to own and operate wind farms in Texas, where we mine coins when the wind blows, and we stop mining when the wind stops blowing. And as a result of that, our cost to mine, marginal cost, is almost zero. There's some cost, but it's almost zero, which makes it ironclad against any kind of halving events. We are thinking very long term. In addition, we have also recently announced an acquisition of Exaion, which was a wholly owned subsidiary of EDF. EDF is one of the largest utilities in the world, focused on clean energy, based out of France. And that is an interesting development on our side. We have been talking and hinting about AI on the edge. We've taken a little bit different approach from our peer group when it comes to AI. We believe this is the right strategy for our stockholders, and we're very excited about that. Looking forward to talking more about it.
Great. Thanks for the intros, guys. So Bitcoin mining is often viewed as a very challenging business. At the halving, the rewards get cut in half. You've constantly got to be growing right into the cycle. This cycle in particular, the hash price has not risen as much as many of us would have liked. Do you view this as sort of a different cycle? Is this something you sort of expected? And how do you think you need to adjust strategically in order to address the challenges in the space? And I'll start with Matt.
Yeah, so I would say that the 4-year cycle is effectively broken with the maturation of Bitcoin as a strategic asset with the ETFs and now the strategic treasury and whatnot. I think the adoption is driving demand. I mean, if you read anything about the most recent ETFs, they've consumed infinitely more Bitcoin than have been generated so far this year. So I think effectively that halving cycle is broken. Additionally, there's a shift, as all of my peers will talk about, that the megawatts that we own, I mean, having over 1,000 megawatts operational or under contract, 800 operational, and another 1.2 gigawatts on the come, the demand for electrical infrastructure and the ability to rapidly build that out has shifted dynamically. A year ago today, we were here talking about the fact that we now have Bitcoin mining operations here in Wyoming, my home state, and the reason that we were successful in procuring megawatts in Cheyenne was because there was a need to rapidly develop and monetize those megawatts, and a Bitcoin miner can do that much more rapidly than a proper full-scale large language model data center. So our speed to market with the electricity has created opportunities such that now we can look at ways to monetize power beyond just Bitcoin mining. So it's allowed us some flexibility, but I think, beyond all of that, the support that's necessary for the Bitcoin network and having the distributed footprint that we have, I mean, with 33 locations, we now have a great deal more flexibility than we ever did before.
That's awesome. Patrick, you comment on Bitcoin mining? I know we've got a lot to talk about elsewhere, but.
Yeah, look, I think I may have a different perspective. I think Bitcoin mining is an incredibly difficult business, right? If you just think about Bitcoin mining like any commodity business in unit economics, 5-cent power costs you $60,000 per Bitcoin, roughly, today, right? So if Bitcoin's at 115,000, literally half of the price of one Bitcoin today, if you have 5-cent power, there you go. Then you add on top of that interest, SG&A, other company operating costs, right? So it's really hard to make a profit mining Bitcoin unless you have really low cost power. And when I look around, I think the challenging part to me about where we are as an industry is there's one massive provider out there who we all love and adore, and that's Bitmain. And Bitmain will continue producing machines whether any of us buy them up here or not, because they're in line with TMSC, and they'll get their chips and they'll build their ASICs, And I think they can probably build those ASICs at $5, $6, $7 a terahash. And if they don't sell them to us at 15 or 16, they take them and they plug them in the US, in Africa, in Russia, in Pakistan, and all over the world. And that's why network hash rate keeps going up and up and up, even though it might not be extremely profitable for any of us to mine a Bitcoin. And that to me is single-handedly like the toughest and largest problem with our industry, in that you have, if I'm buying a terahash at $16 a terahash, and I can tell you that I think I'm going to get a return on that investment in 18 to 24 months, Bitmain, who can produce it at 5 to 6 and plug it in, is getting that return in 9 months. And then everything from there is gravy. So I think that's what makes Bitcoin mining difficult. When you talk about Bitcoin price, you can't talk about Bitcoin price without talking about network hash rate. And so, as I look at it, I think Bitcoin price has to keep going up for it to be profitable, because network hash rate is increasing almost parabolically because of that dynamic.
But if Bitcoin goes to 200 or 250,000 and network hash rate doesn't rise as quickly, won't the mining business get really good for some period of time?
Absolutely. But like any commodity business, right, there's periods of time where the oil market over-earns and under-earns. Yeah. So I think what we've learned, and I think all of us have learned up here, is you have to have a balance sheet and liquidity that can survive that. Yeah. And you got to be positioned, again, to try to be the lowest cost producer so you can survive cycles.
And that's one of the benefits of layering in AI, right? To have some non-correlated revenue stream. So Kent, IREN has a 50 exahash Bitcoin mining business. The company signaled that it won't be growing that in the short term. I think the company originally believed effectively that Bitcoin was a great offtake for the energy and a good way to scale the data center business. Is that still the way you view Bitcoin mining today? Has anything changed in your thought process?
Yeah, I think as far as it relates to the actual Bitcoin mining side of the business and how we think about it, I'd echo some of the comments there. I think being a low-cost producer is fundamentally important, and that's how we've always focused our business, is having control of our sites, having operational control, being in areas that are low-cost power jurisdictions is incredibly important. Having an efficient fleet is very important. But if you can put all of those together, in the way that we think we have, Bitcoin mining is actually a highly profitable business. So to give some direct examples of that at the moment, as Mike mentioned, we're at 50 exahash. That's $1 billion annual revenue run rate at current Bitcoin economics. Our gross margin, so that's revenue less electricity, is 75%. And if you include all of the corporate overheads and SG&A of the business, it's an EBITDA run rate of $650 million. So 65% margins overall for the business. We also like this asymmetric risk profile that you have, in the sense that if you're a low-cost producer, if you do get downturns with the Bitcoin price, all of the high-cost producers will drop out of the network. And that's literally just a marginal cost decision. If you're operating and your electricity cost is higher than the revenue you're making, you will just flick the switch and turn your machines off. That reduces the size of the network, and if you're continuing to operate as a low-cost miner, you get a disproportionately higher share of the Bitcoin rewards. So we like that downside protection as a low-cost producer. And then when you get these runs in the Bitcoin price, given the size of the network now, there can't be enough capacity added to normalize the profit. So you can actually earn outsized returns during those periods. And we do see, as was mentioned earlier, some increase in global hash rate over time in some of these very low-cost power jurisdictions in developing countries. But I think it's hard to add really material capacity in those places. It's very hard to raise capital. This is a capital-intensive industry. There's always a threat of regulation and nationalisation of operations. So I don't see that as a major risk over the long term in terms of size of the network. So I think it can be very profitable. As Mike mentioned, we have put a pause on that for now, but that's really dictated just by the opportunity set that we see on the AI side today. and the potential to really diversify the revenue streams within our business rather than a fundamental view that Bitcoin mining is no longer attractive.
Salman, are people too negative? Are investors too negative on Bitcoin mining?
Look, it's an open secret. This is a difficult business to operate, period, right? That's why you're seeing 4 of us talking about diversification. Having said that, I spent more than 2 decades in oil industry, and this reminds me of those trends in commodity exposed cycle industry. There are some very wealthy families in oil sector who made billions, and then there are others who have filed bankruptcies. And to Pat's point, you have to have a very strong balance sheet to survive these cycles. The challenge in this sector is that you have hash price, which hasn't improved. It has stayed static or deteriorated over time. And that is what Bitcoin miner depends on hash price. It's not just the Bitcoin price. And that's why we like the strategy of not just having Bitcoin mining at scale and being creative about how we mine Bitcoin, but also hold Bitcoin on the balance sheet. Now, we're not a treasury company. We're not MicroStrategy. But we like to have that hedge. If Bitcoin price escalates like it has, for example, the investment that we made last year by going into full HODL, that has given us rate of return of 30, 40, 50%, depending on the price range that you look at today. And that kind of rate of return you won't find with investing in your Bitcoin mining operations or even AI. And the question is, how can you get that so quickly? Some of those investments are longer horizon. So it's a treasury decision for us, but it helps us from our stockholder perspective. It gives them that hedge against the hash price being low while we continue to hold Bitcoin that creates value for them. Now that's one aspect. The other aspect is, look, we have to be creative as a sector, and we've been quite vocal about for years that the traditional Bitcoin mining model after a halving or so may not be feasible. That's a reality. At 5 cents, 4 cents, 6 cents kilowatt hour, even if miners become much more effective, it will plateau over a period of time. And we have to be creative about it. So what we have been looking at is marrying intermittent power with Bitcoin mining. Just a reminder, our return on capital employed, which is one of the most important KPIs in my humble view in capital intensive businesses like us and oil and gas and any other capital intensive industry, ours is 3 times better than our closest competition. And the reason I say that is it's an important element. You have to manage your capital, you have to deploy it properly, you have to have try to get to the lowest cost, as Kent mentioned. That's very important. It has to go. You have to be able to survive in all cycle, bull or bear. But at the same time, investing has to continue in order for you to have a sustainable scale. Global hash rate keeps growing. If you slow down your growth lower than global hash rate, your difficulty level goes up, your cost goes up. And that's the reality of this sector. So you either sign off completely and say, hey, I'm not going to do Bitcoin mining, I'm going to just do AI, or you continue to be in the Bitcoin mining and continue with the pace, and while also diversifying your revenues.
So one of the hottest topics in the entire world right now is the shortage of power. You hear Elon Musk, Sam Altman, all these guys talking about how power is the real constraint to building out large-scale AI, AGI potentially coming in 3 years. Bitcoin miners, legacy Bitcoin miners, went out and acquired a lot of power cheaply over the last 5 years. It seems like that's a pretty incredible opportunity, right, to convert some of that power. I want to start with Patrick on this because Patrick's company, TeraWulf, just announced a $6.7 billion deal with Google as a backstop on Thursday. Your stock has basically doubled over the last 3 or 4 sessions. And
still cheap.
Yeah, it's maybe, right? Do you want to talk us through what happened there? I mean, that was the first time we've seen, this is something I've been saying is going to happen for a year or two, and you finally validated it, but we would see hyperscalers, Google's, Meta's, Amazon's, Microsoft coming directly to these guys on this stage because they need the power available tomorrow in order to scale their AI platform. So how did that deal come together? Tell us about it.
Yeah, look, I think all of us up here, right, have been talking about the value of electrical infrastructure in particular, which is what all of us need to mine Bitcoin. And I think that the demand for that power, we saw it last year when we sold our behind-the-meter Bitcoin facility at Talon's 2.4 gigawatt nuke facility to Amazon, right? So Amazon's cost of capital is a lot lower than mine, and they wanted that power, and they want it for AI. So I don't think we'll ever see another Bitcoin mine behind the meter at a nuke as long as Amazon, Google, Microsoft, Meta, Oracle want power for AI. Because they have a much lower cost of capital than all of us do. But yeah, look, Mike, we're really excited. These things, as everyone can attest to up here, like electrical infrastructure doesn't move quickly. Tech is used to moving quickly and breaking things, but these deals take an extremely long time to come together. It took us, from soup to nuts with Google and FluidStack, 4 to 5 months of very intense due diligence, and then, getting I would break these deals down into two aspects. One is you have to sign a lease, and the lease is very complicated in and of itself. And then as soon as the lease is signed, the team turns to me and Salman and the rest of us up here and says, how do we finance this? So for us, my job really with this transaction was allowing obviously the technical teams at FluidStack, Google, and TeraWulf to kind of come together, get a design that everyone was comfortable with, which really depends on what you're going to be doing at the site, and that drives cost. But then once we had that, trying to figure out, TeraWulf just last week was a $2 billion company. Now we're a $4 billion company, right? And trying to articulate and explain to somebody like Google, right, who's $2 trillion public market cap and only $30 billion of debt, how we're going to do that is difficult. And so I think what I take the most pride in that transaction was really working collectively with those partners to come up with a new mousetrap that I hope now becomes something that the industry can duplicate at other companies, where Google is providing $3.2 billion of backstop lease obligation support to TeraWulf, which effectively allows me to go out and secure financing at a really efficient cost of capital. Yesterday, we did an $850 million convert. That's 6-year money at 1% coupon.
Did that start as 400 million?
It started as 400 million. Yeah, it's the largest upsize in the convert market in 4 years, so really proud of that. But again, that's because we got the right mousetrap with Google. And Google now, with their 3.2 billion of support to us, that's over 10% of their balance sheet obligations. 2 trillion public market cap and only about 30 billion of debt. So getting a $2 trillion company, right, their management team, their board, everyone to sign off on a new and novel concept was not easy. But I'm hopeful that we've kind of provided a roadmap here, and now, some of our peers up here will be able to kind of use that, because I do think the demand for AI is insatiable right now. And I think all of us are really positioned in a great spot to kind of capitalize on that going forward.
Well, congratulations and thank you, because it's a huge validation of everybody's megawatts, and I've noticed the stocks have been a lot stronger even with Bitcoin trading down. I do expect more decoupling from Bitcoin as more companies in this sector actually transition more of their power to AI. Let's go to Kent next, because Kent's actually running a neocloud himself. I mean, CoreWeave went public a few months ago, 3, 4, 5 months ago. Stock went up 3x right away. They don't really own a lot of physical infrastructure. You're kind of coming at it from the other side, developing the infrastructure first, and then plugging in the GPUs. How do you think about co-location versus running your own cloud? Because very few people in this sector have decided to take that approach.
Yeah, well, I think we're in a unique position in that regard, that we do have the ability to play it from two different angles. And they are vastly different when you look at a co-location type model versus a cloud model. Capital intensity is very different. If you are owning the GPUs on top of the data center infrastructure, that's 3x the investment of just the data center infrastructure itself. If you're thinking about co-location, it's these 10, 15, 20-year contracts. Very steady revenue stream, effectively no recontracting risk because they're set term lengths, but much longer payback periods. So you typically see 7 to 10 year payback periods. on the underlying infrastructure cost, whereas on the cloud side, the payback periods tend to be a lot faster, typically around 2 years on the GPU investment alone, and then 3.5 years if you're taking the data center investment into account.
That assumes the pricing on the GPU hours holds up, right?
Correct. But I think if you believe the ultimate thematic, which was our original thesis from day one, was that the demand for compute moving forward is going to massively increase, and we're really seeing that play out in the market at the moment. I think both sides can be attractive, but those payback and returns that we're seeing on the cloud side today look particularly attractive, and I think the demand that we're seeing from customers on both sides is incredibly encouraging, and I would say it's there's a strong variety of players that are coming into this space, including hyperscalers looking for cloud compute, which is an interesting dynamic, and you're starting to see a lot more enterprise customers coming into that space as well. They're a little slower adopters than these AI startups that have traditionally driven the growth in AI compute, but they are coming more and more, and inference is going to play a more and more important role as we move forward, and that's where you're seeing some of this enterprise adoption.
So Salman, Mara said you weren't going to do AI maybe a year ago, but here we are, things have changed. You did some M&A. Maybe walk us through your thinking on why you did that transaction, what your kind of longer term strategy is in terms of addressing AI, HPC.
Just to clarify, we never said we won't do AI.
Okay,
we said
fair.
that we will not do AI the way current Bitcoin miners are pivoting towards AI and HPC with one large customer. We view that business model not to be suitable for us and our stockholders, but we like AI. AI is going to be everywhere, and there's opportunity to tap that market and create value for us. So we announced this acquisition of Xion. Once the transaction closes, we will be 65% owner of that company in partnership with EDF. It serves the data centers in Europe and Canada. Currently, it's got partnerships with NVIDIA, Deloitte, and many other customers. It's got recurring revenues. Currently, it's a startup, but it's got recurring revenues that are out there for the current customers, and they're expected to grow over a period of time exponentially. The angle that we have on the AI front is compute on the edge, and we like compute on the edge, where you have, if you think about it, if I have to simplify for everybody, if you're ExxonMobil, Coca-Cola, PepsiCo, Saudi Aramco, or a hospital, you don't want your data to be mingled in a third-party data center site with everybody else. You want security around it, you want it closer to your location, and that's the piece that we like. We like to serve that market, which is currently very small, and it's expected to grow up to a 160, 170 billion mark in a couple of years. And that's the piece that we like. We like sovereign compute, which allows people to control their data better at closer location to them. We like the aspect of recurring revenues that come with that. We also like that there's a software aspect to it, and also the platform aspect to it. So platform as a service, which can include both GPUs or without GPUs and software. So it's a multiple angle that we're planning to solve, and the credibility that we gain by acquiring an existing sophisticated company that has built this around data centers that are nuclear sites in Europe and clean energy, that really is music to our ears. So that gives us the upside to not only do that right now, but also grow it and invest further and increase our investment or our equity in that company.
Matt, you've got sites that are near city centers. We've all been speculating that maybe you'll get into AI as well. What can you share with us about your current thinking on that?
So we take a different approach to all of our peers, but it's the same end result, and that is energy utilities need an interruptible load. We get preference, like for example, Gary and I last week were in Dalton for the Proto rig launch and had an opportunity to go sit down with principals from utilities throughout Georgia. And they talked about the massive demand for AI, but the fear that the lack of interruptibility at those loads causes them concern. And what we found is that by curtailing our energy consumption for 120 hours a year, we can avoid about a third of our total energy costs. So being that flexible load matters. Now, to the point about AI, you remember back the first day of business school when they talked about the franchisees used to take to Ray Kroc the idea that we need to sell chicken. And Ray Kroc's counter response was, McDonald's is a hamburger place, we need more locations. So more locations, more locations, more locations. And then when they launched chicken nuggets, they were the largest seller of chicken in the nation overnight. So what we've been quietly doing is rolling up megawatts around the country in areas that are very strategic. And you and I have had this conversation before. A lot of the early movers that have sold or subleased or joint ventured on megawatts, in I think our collective opinion, have left a lot of meat on the bone. They may be sold too soon. So what we've looked to identify are areas, and you mentioned Georgia. You know, we have 100 megawatts surrounding the Atlanta airport. So you want to talk about demand for captive energy. That's a prime example. We have another block in Norcross, Georgia. We have a lot of stuff in Tennessee. We have assets, here in Cheyenne. So we've been focused on being the valuable partner for some of these rural utilities to monetize stranded megawatts, give flexibility as they continue to add generation and capacity, balancing those loads because we are flexible. And then I think the next logical step that you'll see, and that our team, we've got a pretty sophisticated team of AI guys led by Taylor Monig. But I think what you'll see is that some of the infrastructure that we have that makes more sense and gives us a higher ROI per megawatt than Bitcoin mining currently does, we're certainly analyzing those very actively.
Great. Well, thank you so much, guys, for sharing your views on AI. Let's go down the line with some kind of final thoughts on where are we in the Bitcoin cycle, right? So is this cycle going to roll over the way it has historically in Q4 of the year after the halving, or is it going to run longer? And then separately, why should someone own your stock? Let's start with Salman.
Look, it's in a commodity exposed cycle, there will be opportunities to buy and sell Bitcoin or shares, as day traders would call it. But we believe our company is surely undervalued today. If you do the sum of the parts analysis and look at the initiatives that we have, you add them together, the math doesn't work.
You have $6 billion of Bitcoin.
We do.
And you have a market cap of $6 billion.
Almost $6 billion.
But you have some convertible debt.
We do have that, but then we also have mining business with worldwide scale.
So you might say the mining business is effectively being valued close to zero at this point.
Yeah. So something to think about from an investor perspective. Obviously, this is not an investment advice, but from our perspective, we are fixated on delivering results because our value driver is going to be long-term value creation that comes with mining Bitcoin at scale, at effective, one of the lowest costs. Our cost power is 4 cents per kilowatt hour, which is one of the lowest in this sector. And then the scale is important. Global diversity is important, not just exposed to one state or two states. We believe expansion around the world is going to drive that value, while also cherry on the top, AI, which will continue to provide that diversity on revenues.
Kent, thoughts on the cycle and why should people consider IREN?
I think, I won't comment on where we are in the cycle because who knows, but I think, as I mentioned, we're a low-cost producer. We have the best fleet efficiency in the industry. Operationally, we're doing very well. We mined the most Bitcoin of any of the listed miners last month. Very low cost of power, all of which means we have very high profitability on the Bitcoin mining side of the business, which gives us a great platform as we look to expand in the other verticals. And then on the AI side, if you consistently look around the industry, you will hear that the pinch point in this industry is around land and power. And we have over 3 gigawatts in the existing portfolio that we've announced, a lot in the development portfolio sitting behind that. And when you look at some of the people, particularly in the neo-cloud space, Nebius, 200 megawatts operating today, a gigawatt secured. CoreWeave, 500 megawatts today, recently bought Core Scientific because they see the pinch point, or attempted to buy Core Scientific, I should say, because they see the pinch point is on land and power, and we think we're very well positioned, given our portfolio, to be able to play both in that space as well as this co-location theme.
Patrick, final thoughts?
Yeah, I'll be quick because it's pretty simple. We're partnered with one of the largest companies in the world. They have approximately 15% stake in our company. They're the largest shareholder. And I've contracted 500 megawatts out of 1.15 total gigawatts. So I have basically double the capacity to offer. And I'm a CFO, so I can't resist, so I have to leave you with this. But if I contract all that up, really cocktail napkin math, it's $1 billion of EBITDA. Digital Realty, Equinix, big data center companies trade at 20 times EBITDA. So billion times 20, $20 billion. It's going to take me about $8 billion of debt to do that. That's 12 billion of equity market cap, and I've got 500 million shares outstanding. That is a $25 stock. The stock is at $9 today. It's still cheap, Mike.
I love it. Matt, final thoughts?
I think over the balance of the decade, Bitcoin is going to evolve from a speculative asset to a global standard for balancing energy networks. CleanSpark has a uniquely balanced position in that we have all of this access to power. One of the, I think, top two with IREN most efficient fleets. We have favorable energy costs, and we've developed a pretty big stack of Bitcoin that we own. So I think with all of that, and then the opportunity to monetize megawatts going forward to supplement that business, I think we're very uniquely positioned as well. And as long as we're talking about value, we have just over $1.5 billion of Bitcoin and about $3.2 billion in net asset value and a $2.8 billion market cap. So we're on sale as well.
All right, guys, we're out of time. I'm going to make one final prediction. I do think Bitcoin's going to 150 to 200 by the end of the year, and I think that means everybody on this stage, their equity value is going to go up, maybe substantially. So that is investment advice. Thank you so much.